Welcome back to our budget countdown special. I've been speaking with Neelkant Mishra, an economist and an equity strategist, and Ashish Gupta, who's the head of fixed income and financial sector specialist. Gentlemen, thank you for your patience. Ashish, I know this is a bit out of syllabus because I called you all for the economy and the budget, but you have to tell me what you've made of HDFC Bank. You've tracked it for the longest time in your previous avatars. Is it a question of just a few quarters to reach? Or is this a new reset that investors have to get used to?
So, Lata, I'll duck this question in the sense that I can't really comment on company specific, stock specific issues, but let me try to address this in more generic terms, right? And I think it is not one bank, but clearly is something we have seen across.
Okay, I think we have a problem with Ashish's audio. I think even the system doesn't want Ashish to comment. Neelkant, to get back to the issue of easy liquidity, do you see the Reserve Bank being able to loosen liquidity later on in the year? Do you think this how long do you think we are going to be in a tight liquidity grip, and how do you see the rate scenario later on?
Yeah, so let's first understand why there is tight liquidity, right? So, and I think we've discussed in your show earlier as well, there are only four moving parts when you're looking at deposits in the system. There is the pace at which RBI is injecting money. There is the pace at which banks are lending. So credit growth in banks is creating money. Third is what is the currency in circulation growth? Because when you take money out of ATMs, you're reducing money in the deposits. And the fourth is government cash balances. So these are the only four ways in which deposits in the system get affected. Now, what has happened to credit growth is it's pretty strong. Currency in circulation growth is not so strong, so that should be good for deposits. There is some temporary increase in government cash balances, about 1 lakh crores or so. But as the government calibrates its spending and its taxation and its market borrowing, that can be easily addressed. The main reason why deposit growth is weak is because the implied money injection by the RBI is nearly zero over the last 18 months. Even in an article published middle of last year, I'd said this is India's quantitative tightening. And this has now reached a point where it's starting to show credit growth. And I think it is intentional. So if you think about what are the three variables which perhaps are driving RBI's behavior or RBI's stance. And so the first is that growth is surprising on the upside. You must have seen even for FY25, whereas consensus is still talking about 6.3, RBI is talking about 7%.
Yes.
So if you are getting surprised on the upside, on the growth side, it would be irrational to expect that the RBI will start easing their stance on any of these fronts, right? That's the first one. The second is that headline inflation is nowhere close to 4% yet.
Yeah.
So core inflation is coming off, and that's because there are low wage pressures, there is a lot of surplus labor in the economy. So we are still below potential, but because of repeated weather disruptions, headline inflation is still not coming.
Neelkant, just a final set of questions to you on the budget itself. What are you expecting? Should we expect a very good capex cycle? One. Two, should we expect some consumption-oriented steps, like the PMGKY? After all, it is a vote on account that's coming before the elections.
Exactly, that's the point, right? So the vote on account happens because the government has to keep functioning even as the country goes through elections. And anything that has policy implications or where you can interpret policy takeaways is something that you should expect to happen in July. In this, the overall stance of the government that they give credible numbers backing 5.3% fiscal deficit, so showing that they are still on the consolidation path and at the same time using reasonable numbers in terms of tax growth. So even though I think that the tax collection growth will again beat the nominal GDP growth, like for example, this year, despite what is, I think 9% is what the first advanced estimates are talking about, we are seeing gross tax revenue grow at 13%. Yes. And despite April, May last year, we had those fuel excise cuts.
So next year, you are expecting only one-time tax buoyancy. I mean, if
more or less,
yeah,
more or less,
Okay.
right? So, and at the same time, so this is what I would expect in the vote on account, right? So when the mid-year numbers that maybe they'll change that in July. But on the expenditure side, remember that a large part of expenditure is mostly committed. So interest expenses, you can almost pinpoint to the last 1,000 crores as to what that number will be. Your salary, pensions, a lot of the defense expenditure. So I do think that there is some room for subsidies to be cut further. Last year, a lot of the consolidation happened because subsidy numbers, because the COVID support
Yes.
was withdrawn, were cut. And some of the room is also coming from the fact that I think this year the government may actually end up with some additional cash on their balance sheet. Basically, I think they have not cut their borrowing numbers, but the inflows into small saving schemes is substantially higher than what they budgeted for. So I think there is 1 to 1.5 lakh crores on 2.5 trillion rupees, which is in surplus, and I think that also should provide some comfort as we think about the next year.
Okay. Well, Ashish, I'm trying for one last time. Your comment on the financial sector. You are going to see lower margins and lower credit growth?
Yeah, so I think lower margins is not really that much of an issue. I think that is to be expected when the repo rate increased over the past 12 months. Margins for the banks expanded beyond what has been their normal range. And really the market was expecting a pullback in margin, right? And therefore, if you see, many banks did not re-rate to the extent their margins improved. So I don't think margin is really a big, really negative surprise. I think concern of the market has been that some of these private banks may have to pull back on loan growth as well, given the need to temper down loan deposit ratio. And that's where I think my expectation would be that going forward, we will need to see some easing of the liquidity conditions from the RBI. As Neelkant also highlighted that really deposits and particularly in aggregate terms is a macro variable, right? So just banks raising deposit rates is not going to meaningfully alter the system deposit growth. And I think another reason why we will need more liquidity infusion is that if we are looking for a nominal GDP growth of 10.5–11%, that is a pickup compared to this year, right? So if you see, we currently are running at a 9% nominal GDP growth. So if we have to target a 11% or 10.5% nominal GDP growth, then the liquidity has to be more enabling than when the nominal GDP growth is 9%.
Fair enough. Unfortunately, out of time, Ashish, we will get you on a later day on a better line. But thank you very much, Neelkant and Ashish, for joining us in this pre-budget special. So it is a vote on account and the market will be comfortable if the fiscal deficit can be anywhere between 5.2 and 5.5%. Axis Bank is itself going with a 5.3% expectation. We wrap up on this special show. Thank you very much for watching.